Everyone wants to figure out how to legally pay less tax on their income, and to some surprise, you're still required to actually pay tax on income received even during your retirement years, whether that be from a pension, an investment portfolio, or any other source of income that you may be bringing in. Plus, there are certain rules that you need to make sure that you're following to be eligible for other retirement programs like old age security. But with proper planning, a little bit of strategy, and some knowledge about the tax code, you can keep more of your own money in your pocket during your retirement years. So that's what we'll be covering in today's video, looking over how different retirement income sources are taxed, some important tax credits to benefit from, and of course, strategies that will keep more money in your pocket. So make sure to hit the like button and let's get into it. So first and foremost, I wanted to highlight what the most common forms of retirement incomes even are, as this will set the tone for the strategies that we'll be discussing throughout the video. So according to the data that I was able to find from benefitscanada.com, the largest sources of retirement income are capital accumulation plans, including group RRSPs, RPPs, TFSAs, and so on, followed by government benefits such as CPP, QPP, and OAS, and then smaller amounts coming from personal registered retirement savings and other personal savings. And by the way, the reason I bring this up is because the way you choose to withdraw from your different investment accounts and claim your various forms of income can play off of each other and actually impact eligibility for certain benefits, specifically for CPP and OAS. Also keep in mind that income sources like the Canada Pension Plan and Old Age Security, as well as any other pension payments, are considered taxable income to you. So although your monthly payments may not withhold tax from the source like you're used to during your career, where taxes are taken directly off of your paycheck and prepaid to the CRA for you, well, that might not actually be the case with your income during retirement. So just keep this in mind and keep money aside to pay for your tax bill, or otherwise you can even call up the CRA and request that they withhold a certain amount of the payments to account for taxes. That's just something that I wanted to mention. All right, so if you're approaching the age of retirement, I would hope that you've been utilizing registered investment accounts to save and invest towards this milestone, allowing you to take advantage of tax deductions along the way and the tax-free growth that inherently comes with these accounts. So realistically, you're probably already aware of the tax-free savings account, having been a registered investment account where you're allowed as a Canadian above the age of 18 to make contributions up to a certain allotted amount each calendar year. But what makes the TFSA a great tool for funding a portion of your retirement income is that the withdrawals from the account are entirely tax-free, and very important, don't impact your taxable income and therefore eligibility for certain income-tested retirement benefits like that old age security we recently mentioned. So therefore, it's generally strategic to fully maximize TFSA contributions during your working years and even consider transferring funds from other taxable investment accounts that you might have open over to your TFSA in order to take full advantage of that tax-free growth and income that the account offers. And really, one of the key benefits of this account is that it allows flexibility like no other account does, in that if you need some money during retirement, it's really easy to pull out of a TFSA and it's not going to impact your taxable income. You can even choose to recontribute to that TFSA if you so choose and have other disposable income. It's a very flexible account. For sake of example, if you play things correctly, even during only say 20 years of your career, well, fully maximizing contribution at a, let's say, steady $7,000 per year contribution limit, although that will increase over time following inflation, well, we'd be looking at a TFSA worth around 180 grand in 20 years, considering annual compounded interest of 8%. So that's definitely a nice chunk of cash that can serve you well in retirement, especially considering it's free of any tax burden whatsoever. Moving on, you probably have a registered retirement savings plan if you're watching this video. And although you're able to claim the contributions that you've made throughout the course of your career as a tax deduction against your income, well, during retirement, your withdrawals themselves actually become taxable income that will for once be subject to the marginal tax brackets that are in place on your income during those retirement years. That said, during retirement, you're actually not going to be making withdrawals from your RRSP. Rather, you'll be required to convert that RRSP that you've been contributing to over your career to what's known as a Registered Retirement Income Fund, or RRIF, RIF for short, by the end of the year where you turn 71 years old. And the goal of the RIF is to convert your RRSP into now an income source during retirement that actually requires mandatory minimum withdrawals each year. And of course, withdrawals from the RIF lead to taxable income. So it's for this reason that you'll most likely really want to strategically plan out your withdrawals to avoid being pushed into a very high marginal tax bracket, especially if you have other income sources as well. Now, do keep in mind though that minimum RIF withdrawals are actually mandatory, and they're determined by a formula set by the Canadian government, where these withdrawals are based on your age or your spouse's age if you so choose, as well as the value of your RIF at the beginning of each calendar year during retirement. So for individuals aged 71 or older, the formula for minimum withdrawals is as follows. And for sake of example, let's say your RIF's value is $500,000 on January 1st and you are 71 years old. Well, based on this formula, this would mean that your minimum withdrawal amount for the year would be $26,400. And it's important to note that based on how this formula works, well, as you age, the withdrawal percentage increases as well, following the minimum withdrawal percentages outlined in this table right here. Feel free to pause the video in order to take a better look. Now, considering there is a minimum withdrawal amount per year, there actually is not a maximum withdrawal limit. You could drain the account in your first year of retirement if you so choose, but that's probably not a good idea. And overall, it's really important to sit down and consider a plan for your withdrawals over the years, as these amounts are added to your taxable income in the year of the withdrawal, which could mean a much higher marginal tax rate, right? If you know that you have, say, a real estate portfolio that nets you $100,000 a year in cash flows, that is a situation many Canadians find themselves in during retirement. Well, then it's probably more strategic for you to keep your RIF withdrawals near the minimums to avoid even higher taxation, especially if your lifestyle doesn't require that extra income. But ultimately, it is going to be case by case, and you need to sit down and understand what the best course of action is for yourself. Now, you also need to consider that any amount you withdraw from your RIF above that minimum amount will be subject to a withholding tax at the source, which is prepaid for you to the CRA following these federal tax rates. So withdrawals up to $5,000 above the minimum will be subject to a 10% withholding tax plus 5% if you're in Quebec. $5,001 to $15,000, 20% withholding tax plus 10% in Quebec, and then any amount over $15,000 that exceeds your minimum amount, 30% withholding tax plus 15% in Quebec. So these withholding rates could very well be amounts that exceed what you'll actually be paying during tax season, but you need to consider them in your monthly budget, even though you may receive a tax refund at the end of the year once your deductions and other tax credits are taken into account. And this leads us into the next consideration to make if you're married that can lower your tax burden. Pension income splitting is a tax strategy available to Canadian retirees, allowing households to reduce their overall tax burden by reallocating up to 50% of eligible pension income from a higher income spouse or common law partner over to a lower income spouse. And this allows couples to take advantage of lower tax brackets, potentially reducing their combined tax bill. So the way this works is that income from a RIF, annuities, and other qualifying pension plans are eligible for this income splitting process, where during your tax filing, the higher income spouse can allocate up to 50% of their eligible pension income to the lower income spouse who's likely to be in a lower tax bracket bracket to begin with, and the individual transferring the income can hopefully drop into a lower tax bracket as well. Now, this is done using Form T1032, the Joint Election to Split Pension Income form, which both spouses must sign and submit with their tax returns. So if you're in a position to do so, absolutely take advantage, because it's a great way to reduce your family's overall tax burden for very little effort. For sake of example, let's consider a couple where one spouse receives $50,000 in RIF income, while the other spouse has no taxable income. Well, without income splitting, the first spouse's $50,000 would be fully taxed in their higher tax bracket, say at around $7,500 in taxes if living in Ontario. But by transferring 50% of the RIF income, being 25 grand, to the zero income spouse, well, the couple can now report only $25,000 each in RIF income, saving a couple $1,000s in overall income taxes paid. Also keep in mind that for higher income retirees, income splitting may reduce net income below the threshold for the old age security clawback, allowing them to retain more of their OAS benefit. More on that later. Next up, this is a strategy that could allow you to save on taxes, considering you'll be forced to withdraw larger minimums from your RIF as you age. And it's a strategy that you may want to employ to receive larger CPP and OAS payments after age 70, while more actively drawing from your RIF earlier in retirement at levels above your minimum to try and ensure a more even and consistent average tax rate throughout your years of retirement. So by delaying your Canada pension plan and old age security benefits, you can actually boost your future annual retirement income, where the way it works is that for every month you delay CPP benefits past age 65, your payments increase by 0.7% per month. And for OAS, the increase is 0.6% per month up to age 70. And so this means that delaying both benefits to age 70 could result in payments that are 42 and 36% higher respectively, compared to starting at age 65. So depending on how your retirement's set up with an investment portfolio and or pension, well, you may not be in a position of needing those CPP and OAS payments in early retirement. So this is ultimately a decision that'll entirely depend on your immediate cash needs along with your tax strategy. And I'll say it again in the video here, having a proper plan and financial strategy in place during retirement is absolutely paramount. Otherwise, you're all over the place in your withdrawals from your various accounts, and it's almost guaranteed that you'll be in a position of paying more tax to CRA than you actually have to be. Hey, just a quick note here to mention that if you're interested in learning more about investing in the stock market on your own, make sure to check out my fully free stock market investing course over on Skillshare. It now has over 3,000 students and over 7 hours of content to watch. Once again, completely free for you to watch, and a great way to also support the channel. Additionally, if you need to open up a TFSA, RSP, or other investment account, make sure to check out the link down below over to Moomoo, where you can get free money for signing up and funding an account. Moomoo is quickly becoming one of Canada's best stock market platforms that also offers a variety of built-in tools for free to the user and amazing foreign transaction fees. So once again, check them out down below in this video's description. All right, now Old Age Security, OAS for short, is a federal government pension program in Canada designed to provide a basic level of income to seniors during retirement. And it's one of the three main pillars of Canada's retirement income system, alongside the Canada Pension Plan and private savings such as RRSPs or TFSAs. But depending on how much income you're bringing in during retirement, well, you may be subject to what's known as OAS Clawback, which can significantly impact your retirement income if your net income exceeds a certain threshold, where for the 2025 tax year, this threshold is set at $90,997, meaning that for every dollar of income that you earn above this amount, the government reduces your OAS payments by 15 cents. And this will differ based on your age as follows. So from ages 65 to 74, OAS benefits begin to be reduced when your net income exceeds $90,997 and are then then fully eliminated at $148,451. For ages 75 and over, OAS benefits start to be reduced when your net income surpasses $90,997, but are then completely eliminated a little bit later at $154,196. This is because the reduction rate is 15% of the amount by which your income exceeds that threshold, right? For example, if your net income is $100,000, well, it exceeds the $90,997 threshold by $9,003. Therefore, 15% of $9,003 is $1,350, which would be the amount deducted from your annual OAS benefits. Now, it's important to note that the OAS clawback is based on individual net income, not household income. So to manage the impact of the OAS clawback, you should consider strategies such as income splitting with a spouse that we spoke about earlier, or adjusting your income through tax-efficient withdrawal strategies from your various registered accounts. For example, withdrawals from a TFSA do not count as taxable income. So if you need, say, 10 grand to cover some expenses, withdrawing it from your TFSA rather than a RIF can help you stay below the clawback threshold, as RIF withdrawals count as taxable income. Also, if your spouse or common law partner has a lower income, remember, you can split up to 50% of eligible pension income, for example, RIF withdrawals, with them, which reduces your taxable income. So for instance, if your income is $100,000 and your spouse earns 40 grand, transferring $10,000 of your pension income could bring you below the clawback threshold as well. Next up, we need to consider tax credits as a potentially viable way for you to reduce your taxes owing during retirement on the income that you're bringing in. And although general tax credits that apply to all Canadians will still very much apply during retirement, well, there are a couple retirement specific ones that you need to be aware of, such as the following. The age credit, which is a non-refundable tax credit available for individuals aged 65 and older, providing a base amount of up to $8,396, which translates into a federal tax reduction of up to $1,259, with provincial tax savings amounts varying. That being said, the age credit amount begins to phase out once your net income exceeds a certain threshold, which for 2024, this threshold is $42,335, and the credit is fully eliminated when your net income reaches $98,309. The second tax credit is the pension income credit, where individuals aged 65 or older can claim the credit for eligible pension income, such as payments from a registered pension plan. So the federal tax credit applies to the first $2,000 of qualifying pension income, providing a federal tax reduction of up to 15% of that $2,000 or $300, plus additional provincial and territorial credits may vary. Do note though that eligible pension plan payments include lifetime annuity payments from a registered pension plan and certain payments from a registered retirement income fund, your RIF, but does not include OAS payments or the CPP payments, as well as QPP payments. Tax credit number 3 here is the medical expense tax credit, where you can claim medical expenses incurred for yourself, your spouse, common law partner, and your dependents. And during retirement, medical expenses may very well increase, so this is an important one to be aware of. For the 2024 tax year, you can claim the portion of your eligible expenses that exceed the lesser of 3% of your net income or $2,635. So essentially, if you had eligible medical expenses of say $5,000 and your net income was $40,000, well, 3% of that amount is $1,200. So your medical expense tax credit would be in the amount of $3,800. And finally, we can't forget the disability tax credit, which for many may apply during retirement. To qualify, you must have a severe and prolonged impairment in physical or mental functions that is expected to last at least 12 months, significantly restricts your ability to perform basic activities of daily living, or requires life-sustaining therapy, as well as a medical practitioner must certify your condition using the T2201 disability tax credit certificate. If you are eligible though for the 2024 tax year, the federal credit is $9,428, translating into a tax reduction of up to $1,414, plus those additional provincial and territorial credits may also apply varying by location. Make sure to check out my other tax strategy videos on the channel. There are a bunch of them, and don't forget to also utilize the links down below for accounts and platforms that I use and recommend. Thanks a lot for watching. Subscribe.